Welcome to The Explainer. Today, we're putting on our Warren Buffett hats and diving deep into the financial filings of Comcast, ticker symbol CMCSA. When you follow the philosophy of classic value investing, finding a massive gap between a stock's market price and its intrinsic business value is the ultimate goal. So let's look closely at the unfiltered numbers to see if Mr. Market has gotten this media giant completely wrong.
We've got a lot of ground to cover today. We'll start with a quick snapshot of where the business is at right now, unpack the valuation by looking at price versus value, then dig into their profitability, examine their dividend profile, and finally, deliver our final verdict. Let's get right into it.
Section 1. The Comcast Snapshot.
So I want you to anchor yourself to this number, $24.94. That's Comcast's last closing price. And at that price point, the market is valuing this entire media and telecommunications empire at just over $89 billion. Now keep that market cap in the back of your mind as we go through the actual cash this business generates. It's going to set the stage for a pretty massive valuation gap we're about to uncover.
Look at this stark contrast in the shareholder experience. It really depends entirely on when you bought in. If you've been holding for 10 years, you're sitting on a really solid gain of nearly 128%. But if you bought into Comcast 5 years ago, you've lost over 45% of your investment. And in just the last year, the total return is down over 17%. It's pretty clear market sentiment has completely soured here, just relentlessly punishing the stock over the medium term.
And that brings us to the core mystery of today's explainer. While the market has pushed the current price down to roughly $24, our discounted cash flow models, based on the actual numbers in their filings, spit out a calculated fair value of $86.35. I mean, let that sink in for a second. The intrinsic value, based on the real cash this business brings in, massively overshadows the current price tag. We're not talking about a slight discount here. This is an absolute chasm between price and value.
Section 2. Valuation. Price versus value. When we look closely at the multiples, Comcast isn't just cheap relative to the broader market. It's trading at a massive discount compared to its own historical averages. I mean, a PE ratio of 4.91? That is staggeringly low for an $89 billion company, sitting nearly 48% below its own 3-year average. The price-to-sales ratio is at just 0.71, meaning you're literally paying 71 cents for every dollar of sales. And if we look at enterprise value to EBITDA, which is a fantastic metric for assessing core operating profitability, it's just 4.71. That's over 15% below its recent historical norm. Across the board, these multiples are heavily compressed.
But here's the real kicker. This tiny PEG ratio of just 0.20. As you probably know, the PEG ratio measures a stock's valuation against its expected earnings growth. In a traditional value investing framework, a PEG of 1.0 is considered fair value, and anything under 1.0 is undervalued. So a PEG of 0.20, that signals extreme, almost alarming undervaluation. It's basically telling us the market is completely discounting this company's ability to grow its earnings whatsoever.
And all of this data builds right into the ultimate value investing concept, pioneered by Benjamin Graham, the margin of safety. Based on our calculated intrinsic value, Comcast boasts a staggering 71.12% margin of safety. In plain English, the intrinsic value of this company could theoretically plummet by more than 2/3, and an investor buying at today's prices would still be protected from a permanent loss of capital. That is a massive, massive theoretical cushion against any unforeseen risks or calculation errors.
Section 3. Profitability and Returns.
You might be thinking, a stock priced this low must be absolutely bleeding money, right? Well, the raw numbers tell a completely different story. Over the trailing 12 months, Comcast has proven to be an absolute cash-generating machine. We're talking over $125 billion in revenue. From that, they generated nearly $18.8 billion in net income. And crucially, this is what Buffett would call owner earnings, over $17.7 billion in pure free cash flow. That's the actual cash left over after paying all operating expenses and capital expenditures. Real money that can be used to pay down debt, buy back stock, or fund dividends.
Because that free cash flow number is so high and the stock price is so beaten down, we end up with this massive 19.86% free cash flow yield. Honestly, this might be the most important metric we discussed today. A roughly 20% free cash flow yield essentially means that if you bought the entire company today at its current market valuation, the business would generate enough cash to pay you back 1/5 of your purchase price in just one single year. Plus,
This current yield is a whopping 62% higher than Comcast's own 3-year average.
And these high-level margins really confirm the strong fundamental health of the underlying business. A gross profit margin of nearly 71%? That shows incredible pricing power and a solid economic moat. A net profit margin over 16% proves a fantastic chunk of that revenue actually makes it all the way to the bottom line. And a return on equity sitting comfortably over 21% demonstrates that management is highly effective at allocating shareholder capital to generate consistent returns.
Section 4. The dividend profile.
With all that free cash flow, we really need to look at how Comcast is returning capital to shareholders. And if you're an income investor, this is basically a dream scorecard. Right now, Comcast offers a juicy 5.29% dividend yield. But you know as well as I do, a high yield is meaningless if it's not reliable. Here, that yield is backed by an incredible 18 consecutive years of dividend increases. And they aren't just raising it by a penny to keep the streak alive either. Over the last 5 years, the dividend has grown at a compound annual growth rate of 5.72%. So you're getting a high starting yield with a long history of inflation-beating growth.
But what you should really take away from this is the absolute safety of that dividend. Sometimes a super high yield is a massive red flag that a cut is coming. Not here. The free cash flow payout ratio is incredibly low at just 26.65%. That means Comcast is paying out that generous 5.3% dividend using only about a quarter of its generated free cash flow. The remaining 73% of their cash is being retained. They can use that to pay down debt, which, by the way, sits at a very manageable debt-to-equity ratio of 1.07, or they can use it to aggressively repurchase their own deeply undervalued shares.
Section 5. The final verdict.
So, we're basically left staring at two drastically different stories for the exact same company. On one side, we have the bear case, driven completely by market sentiment and some recent growth struggles. The stock is down 45% over 5 years, the trailing 12-month earnings per share has shrunk by 32%, and year-to-date returns are still negative. The market clearly sees some structural headwinds. But on the flip side, we have the bull case, grounded entirely in the raw financial data. A nearly 20% free cash flow yield, a 71% margin of safety based on discounted cash flows, and a 16% net margin generating almost $18 billion in pure, unadulterated cash.
The numbers don't lie, but they certainly raise a profound question. I'll leave you with this provocative thought to explore further. When a stock's price drops continuously over a 5-year period, but the fundamental underlying business keeps generating $18 billion in free cash flow, alongside an ultra-safe 5.3% dividend yield, well, are we looking at a classic value trap? Or is this the ultimate value play? Thank you so much for joining me on this explainer. I highly encourage you to pull up those filings and dig into these numbers for yourself. Keep learning and stay focused.